Hi, welcome to Finance, Business and Investing. In this video, you will learn about the top 25 most important investment decisions made by Warren Buffett, the greatest investor of all time, deals that made him a legend, and a billionaire. Anyone interested in understanding Buffett's investment strategies must be aware of these transactions, and I believe you will be surprised even if you have seen a few videos or read a few books about him previously. For example, his $36 billion investment in Apple does not even appear on this list. Before revealing the 25th spot on this list, which belongs to Disney, let's figure out what's driving these rankings. To avoid the effects of hindsight, I will present investments with both positive and negative outcomes. What matters is Warren Buffett's level of conviction at the time of purchase, or how much he was willing to commit to a particular investment. So a deal worth $10 million, $20 million, and $500,000. With that out of the way, Warren Buffett's 25th most important investment was in Disney in 1966. Buffett purchased the entire world. Buffett invested in the Disney company through his then existing investment partnership, Buffett Partnership Limited, or BPL. The partnership spent $4 million for about 5% of the company at a time when Disney's market cap was $90 million and it had $11 million in earnings. In addition, the partnership spent approximately 9% of its capital on Disney stock. This was also 9% of his net worth at the time. A year later, he sold the shares for 48 cents each. A nice 55% profit. Buffett has joked that this decision may appear brilliant, but only if you ignore the fact that the stock is currently trading at $131. Buffett had not yet discovered that his preferred holding period for great companies is forever. The Oracle of Omaha has revealed some of the reasons why he was interested in purchasing Disney at the time. Buffett recognized the resale value of Disney's assets, recognizing that remakes and sequels could be released frequently and that the films would appeal to a new generation of children every 7 years or so. This is analogous to having an oil well where all of the oil seeps back in. Furthermore, actor costs could be kept low in comparison to other companies in the film industry. Mickey would never argue in favor of a race. More importantly, the company was selling at a reasonable price, according to the $17 million buffet at Disneyland. The Pirates of the Caribbean ride would be available soon. Imagine my delight when I discovered that a company was selling only 5 rides. One lesson to be learned here is that you should not sell a fantastic company too soon, even if the price has temporarily increased. From film and amusement parks to newspapers, time is the friend of the wonderful company and the enemy of the mediocre. Number 24, The Washington Post. Warren Buffett's Berkshire Hathaway purchased a 9% stake in the Washington Post for $10.6 million in 1973. Buffett's stake in the company through Berkshire also represented about 9% of his net worth at the time. The Post earned $9.7 million in 1972 and had a market capitalization of about $110 million. As a result, the price-to-earnings ratio, or P/E, the company's age was 11. Berkshire's shares in the Washington Post were worth $1.7 billion when Buffett purchased them at their peak in 2005. However, the internet has killed most newspapers over the last 2 decades. As a result, Buffett sold the company in 2014 for $740 million at the time. Why was Buffett interested in a newspaper business in the first place? Back in the 1970s, newspapers were essentially monopolies. Buffett liked this type of business if they were dominant in their cities because their pricing power was exceptional. First, everyone in Washington who wanted to keep up with what was going on in the world had to pay for the paper. Then, because almost everyone in the city did this, advertisers had to pay whatever rates the Post decided on if they wanted to reach the people of Washington. It had dropped from an estimated value of around 180 million to 110 million in a very short period of time. Buffett was well aware that the market was behaving irrationally. Buffett stated that one takeaway from this investment is that the stock's beta and volatility are not a good measure of its risk. And because it happened so quickly, the beta of the stock actually increased, and a professor would have told you that the stock company was more risky if you bought it for 80 million than if you bought it for 170 million, which is something I've pondered ever since. They told me that 25 years ago, and I still don't understand it. Moving on to number 23, Scott Fetzer. Scott Fetzer was and still is a business conglomerate. And when Warren Buffett bought it, the two largest operations were the World Book Encyclopedia and Kirby, a vacuum cleaner manufacturer. These two companies accounted for more than half of Scott Fetzer's earnings. And this investment demonstrates that boredom arbitrage is a real thing in the world of investing. Berkshire Hathaway purchased the company on January 1st, 1986 for $315 million, representing 10% of his personal net worth. This is the first, but certainly not the last, transaction in which Buffett purchased the entire company rather than just a few shares in the market, with $40.6 million in net earnings in 1980 for the purchase was made at a P/E ratio of approximately 8. The profits from this transaction are unknown, but Scott Fetzer has distributed $1 billion over 15 years of ownership. What piqued Buffett's interest in vacuum cleaners? You may inquire. In his 1985 annual letter to Berkshire Hathaway shareholders, Warren Buffett says that Scott Fetzer is a model of the type of business he wants to buy. It's a reasonable lodge that's well managed and profitable. The owners of Scott Fetzer attempted but failed to sell the business in 1985, just before Buffett purchased an investment bank had been hired for this task and was going to receive a few $1 million from the deal, even though Buffett hadn't used them at all to make the purchase, a fellow from the investment bank. This was said to Charlie Munger, Buffett's right-hand man. Well, we prepared this book in connection with Scott Fetzer, and since you're paying us a couple of $1 million and I've got nothing so far, maybe you'd like to have this book. Charlie said, with his usual tax, I'll pay you $2 million if you don't show me the book. In other words, make your own investment decisions and don't listen to others, particularly investment bankers paid to sell the company. It's like asking your barber if you should get a haircut. Regarding Charlie Munger, Warren Buffett's 22nd largest deal is related to cotton shops. Buffett co-founded Diversified Retailing with Charlie Munger and another guy named David Gottsman in 1966. This was the first time Buffett and Munger collaborated financially, and their friendship proved very fruitful. Charlie Munger has been the vice chairman of Berkshire Hathaway since 1984, and he has had a great influence over Buffett, and thus many of the investments on this list. The company of popular-priced women's apparel stores was Associated Corner Shops, later renamed Associated Retail Stores. In 1967, Diversified Retailing purchased the entire company for $4 million, representing 11% of Buffett's net worth when his stake in Diversified was taken into account. Based on the company's net income in 1968, this deal was made at a P/4 of a kind. Yes, 4. The outcome of the transaction is not separately identifiable, but Buffett stated in 1979 that Ben Rosner at Associated Retail Stores continues to pull rabbits out of hats. Large rabbits emerge from a small hat. Year after year, he generates extremely high earnings per unit of capital employed. My guess is that Buffett purchased this company because of the low price and because he admired the management. Furthermore, this investment demonstrates Buffett's preference for companies with a high return on assets. According to Buffett, the earnings on capital employed in Associated Collins stores were around 20%. Number 21. Excellent. This one is intriguing because it has the shortest holding period of any investment on this list. Buffett's journey through Berkshire. Hathaway purchased Exxon in 1984, before it had grown into the behemoth that it is today. ExxonMobil. However, it was already registered at this time, with a market capitalization of around $20 billion. Buffett paid $173 million for a fraction of a single percentage point of the company. Buffett's net worth was $680 million in mid-1984, accounting for 46% of Berkshire's outstanding shares. As a result, the transaction represented 12% of his net worth at the time. Once again, the stock he purchased was reasonably priced at 7 ISH per share. Exxon shares were sold again in 1985, and based on the stock price at the time, I estimate that the return on this particular investment was in the region of 30%. So, what prompted Buffett to invest in an oil company in 1984? So far, I've found no information on the subject. But one reason could be that Buffett was betting on oil prices, which had dropped from around $38 in December 1979 to $28 in 1984. If Buffett was betting on crude oil, he really lucked out here. Prices fell all the way down to $10 in 1986. Phew! The takeaway here is that even Warren Buffett, the legendary long-term investor, makes short-term moves from time to time rather than sitting on a pile of cash. Interestingly, Buffett made a similar move in 2013 when he purchased 0.9% of the then-merged ExxonMobil. At the time, the company's stock price had increased 20 times, but Buffett's net worth had increased nearly 100 times. As a result, the trade in 1984 was more important than the trade in 2013. Kaiser Aluminium and Chemical Company, number 20. A typical industrial company with operations within, you can probably guess from the name, appeared on Buffett's radar in 1977 or possibly much earlier. However, this was when Buffett made his first Berkshire Hathaway purchases. By 1979, he had acquired approximately 3% of the company's shares for an aggregate price of $20.6 million. This amounted to about 12% of his net worth at the time. Buffett sold in 1981, assuming he received the market price last listed in Berkshire Hathaway annual reports. This investment produced a 35% return. Not too shabby. However, it was not quite Buffett standard for a holding period of 3 to 4 years. This company was priced similarly to related corner shops at a P/E. There was still a lot of Benjamin Graham left in him, who emphasized that tangible assets and current earnings are the most reliable measurements on which investment decisions can be based. Number 19 Safe code. Here comes a major jump in percentages of net worth invested, but it's nothing compared to what you will see later in this video. Primarily in 1978, Buffett purchased 6% of the shares of S&P 500. The investment accounted for 17% of his net worth. All in all, the company's P was extremely low. The E ratio. However, it is critical to understand that the earnings of insurance companies fluctuate. They vary greatly from year to year. The following year, there are few claims to be paid, and investment profits are high. In any case, the opposite could be true. The company was sold in 1981 and 1982, yielding a 50% return on an investment. In his 1978 letter to Berkshire shareholders, Buffett describes one of the reasons for being in Safe Code. Safe Code is most likely the most well-managed large property and casualty insurance company in the United States. It doesn't always have to be more complicated than that. Warren Buffett's number 18 most important investment is in capital cities. First, a little background on this media behemoth. On March 19, Capital Cities announced that it would buy ACC for $3.5 billion, shocking the media industry because ACC was 4 times larger than Capital Cities. The transaction was the largest non-oil merger in world business history at the time. Based on the 1986 earnings, Buffett helped finance this deal through Berkshire, and in exchange for $516 million, Berkshire received approximately 18% of the shares of the merged companies. Buffett purchased this method from AP. He had an E ratio of 16 and was wagering 17% of his net worth on this single transaction. This may appear to be quite costly when you compare it to the previous deals you've seen in this video, but not when compared to the current stock market price. Oh, my goodness. Fortunately, 1/3 of the holding was sold in 1993 for $600 million, meaning Buffett had already made a small profit. Plus, he still had 2/3 of his holdings. Keeping the remaining pot proved to be a wise decision. As previously stated, Disney acquired Capital Cities ABC in 1996 in a massive deal in which Berkshire received $1.2 billion in cash, and $1.3 billion in Disney stock. Thus, the total profit of this transaction was $2.6 billion, representing a 500% return. Here are 2 reasons why I believe Warren Buffett was drawn to Capital Cities. It possessed valuable assets such as television and radio stations. Although the company was not a net stock, these properties could still be sold for a significant portion of what the entire company was selling for. Tom Murphy, arguably one of the greatest managers of all time, was in charge of the company. Dan Burke and Tom Murphy are not only excellent managers, they are exactly the type of men you would want your daughter to marry. The lesson here is that patience is essential when it comes to investing. Buffett had long been interested in Capital Cities. He even owned the stock in the late 1970s. He knew it was a great company with great management, but all he needed was the right price. He waited for about 10 years, which makes me immediately regret complaining about how expensive the market has been for a long time. Burlington Northern Santa Fe, or BNSF. Here's a more recent investment made between 2006 and 2010, with a focus on 2010. Berkshire acquired all outstanding shares in one of North America's 2 largest freight railway companies. BNSF. BNSF is a massive corporation that is nearly large enough on its own to qualify for the Fortune 500 list. Berkshire paid a total of $33 billion, or 18% of Buffett's net worth at the time, after adjusting for his ownership in Berkshire. Buffett did something he despises when he acquired the remaining 77.5% of the company in 2010. Our blockbuster deal with BNSF required us to issue approximately 95,000 Berkshire shares, which amounted to 6.1% of those previously outstanding, Charlie. And I like issuing Berkshire stock about as much as we like getting ready for a colonoscopy. The reason is straightforward. Buffett does not like paying 6.1% of the outstanding businesses in Berkshire, such as Coca-Cola, Geico, General Re, American Express, and so on. By issuing 6.1% of Berkshire's stock, he loses 6.1% of his interest in these businesses, but he and Charlie thought that BNSF was worth it with a net income of $2.1 billion in 2008 and $1.7 billion in 2009. The final purchases P/E ranged from 16 to 20. However, the company's earnings have recently increased significantly, and based on $5.5 billion in earnings in 2019, the P in BNSF would be reduced to 6. I believe Buffett is an asset that is difficult to compete with, difficult to substitute, and will necessitate more cash investment in the future. At reasonable returns in a world where interest rates may be extremely low. Buffett's refusal to issue Berkshire stock in new deals with BNSF. Being an exception, however, teaches us a valuable investing lesson. Sometimes the best bet is simply to double down on what you already own before moving on to the next deal. We'll take a quick look at which investment vehicles Buffett controlled in the 1960s, 1970s, and 1980s because understanding his calming investment decisions is critical. Buffett merged several separate investment partnerships into a single larger one BPL in 1962. He ran this partnership until 1970, when he decided that he had run out of good investment opportunities and decided to dissolve it. He co-founded Diversified Retailing with previously mentioned Charlie Munger and David Gottsman in 1966. Buffett later demanded personal stakes in this entity separate from BPL. In 1962, he founded Berkshire Hathaway, in which he BPL and diversified all of his investments. You can see how this is becoming more complicated, but you still don't know about the final piece of the puzzle, which is blue chip stamps. And yes, you guessed it. Buffett BPL Diversified and Berkshire Hathaway both owned shares in this company at some point, and all of these investment vehicles then bought other companies separately. It's no surprise that the second was interested in this back then. However, no legal action was taken, and by 1983, Buffett had entangled this financial, not by merging everything into Berkshire except BPL, which ceased operations in 1970. This, I believe, is why no one I am aware of has attempted to make a topless like this one about Buffett's investments before calculating Buffett's interest in a deal. When Blue Chip Stamps was the acquirer and Buffett simultaneously increased his said interest in Blue Chip is an exercise, which can get quite bothersome. Pinkerton was and still is a service firm that provides uniformed God services. When Buffett purchased this, Wall Street referred to it as the rent-a-cop business. Pinkerton was the most powerful player in the U.S. During the time period 1976 to 1978, Buffett purchased this company for Blue Chip Stamps. He raised his holdings in Blue Chip from 34% to 41%. The final 37% of Pinkerton was purchased for $24 million, and Buffett's stake in this, including indirect purchases in Blue Chip, was 19% of his then net worth. Pinkerton was purchased by American Brands in 1983 for $162 million, respectively, and Buffett's return on this deal was 150%, plus some dividends. There's an important takeaway from Buffett's investment vehicle structure here: owning multiple businesses allows you to leverage control. Buffett did not want control of these companies' operations, but he did want control of their capital. Assume you have $510,000 to invest but want to increase your investment. Then you come across companies A, B, and C. For the sake of simplicity, these companies are simply holders of $1 million. 100% of any of these companies for $1 million, 51% or less of a company to control it. So you spend $510,000 to acquire control of Company A. Then you use the cash from Company A to buy a controlling stake in Company B. Finally, you use Company B's cash to buy Company C. You've now turned your initial $510,000 into nearly $2 million in your possession. Now, this will only be profitable in the long run. If A, you can deploy the $2 million as profitably as you did the initial $510,000, and B, if you are able to purchase more shares of A, B, and C later on, at valuations lower than their intrinsic value. I believe there is no doubt that at least it proved to be true, as Buffett was asked, "How do you feel?" in a 1970 Forbes interview at the bottom of the then bear market. He responded in the manner of an oversexed man in a brothel. Now is the time to invest and become wealthy. Pinkerton was acquired by the Swedish security company Securities in 1999, which is an extremely important side note. Number 15. Coca-Cola. Warren Buffett purchased huge chunks of the world's leading beverage company through Berkshire Hathaway in 1988 and 1994, totaling $1.3 billion, 19% of Buffett's net worth. This is one of the more expensive purchases that Buffett has ever made in terms of valuations based on Coca-Cola's income. Berkshire Hathaway purchased AP in 1987. Of 19 in 1988. They owned 7.8% of the company in 1994. Buffett has not required any additional shares in the company since these purchases, but Berkshire's ownership has increased to 9.2% as a result of Coca-Cola share repurchases. This investment is now worth $22 billion, resulting in a nearly $21 billion profit. Nonetheless, Warren Buffett considers cocaine to be one of his biggest emissions. This Coca-Cola investment is yet another example of your chairman's incredible speed in responding to investment opportunities, no matter how obscure or well disguised they may be. I believe I had my first Coca-Cola in either 1935 or 1936, and it was in 1936 that I began buying 6 for 25 cents from Buffett & Son, the family grocery store, to sell around the neighborhood for 5 cents each in this foray into high-margin retailing. I duly noted the product's extraordinary consumer appeal and commercial potential. I continued to notice these characteristics for the next 52 years as Coke blanketed the world. Instead, I avoided purchasing even a single share, allocating a large portion of my network to street railway companies, windmill manufacturers, parasite producers, textile businesses, trading stamp issuers, and the like. My brain finally made contact with my eyes in the summer of 1988. Of course, we should have begun purchasing Coke much sooner. Soon after, Roberto and Don took over the reins. In fact, if I had been thinking clearly, I would have convinced my grandfather to sell the grocery store in 1936 and invest the proceeds entirely in Coca-Cola stock. My lesson has been learned. My response time to the next obviously appealing idea will be reduced to well under 50 years. The list of reasons why Buffett might have been interested in Coca-Cola stock goes on and on. It had exceptional brand power. It held significant potential for global consumption expansion. It wasn't even close to what it was in the United States. When Buffett bought it, it had excellent cost control conditions, among other things. Number 14, Salomon Brothers, was an investment bank, and this is a fairly unusual commitment of Buffett's in his 1987 annual letter to Berkshire shareholders, which he testifies to. By definition, we have no special insight into the direction or future profitability of investment banking. In any case, the economics of this industry are far less predictable than those of most other industries in which we have significant investments. Berkshire purchased $700 million in 9% preferred stock in 1987. The preferred shares could be converted into Salomon common stock as well. Later in 1994, I believe he spent another $300 million, or 22% of his net worth. Again, after accounting for his own ownership of Berkshire. The 20% ownership of Salmon was later sold in stages until 1997, when Travelers Group acquired the company. When the preferred dividends received by Berkshire were factored in, the return on this investment was around 150%. I believe the primary reason Buffett purchased Salmon in the first place was because he liked the terms of the instrument, 9% yearly dividends with the option to convert into common shares at reasonable prices can turn out to be a very valuable investment, especially in a stock market that was hitting all-time highs. Keep in mind that Buffett prefers bear markets. In fact, many Salomon executives were outraged at the time. They thought the deal Buffett got was too good to be true, but it didn't always appear to be. In order to restore the company's reputation, Warren Buffett had to step in as interim chairman in 1991. Paul Moser, a Salomon managing director, had been bidding for governmental securities using customer accounts in order to receive larger portions of these securities than were legally permissible in the buildings. Salomon was nearly bankrupt at one point, but Buffett saved the sinking ship a few years later. He sarcastically noted, "Moser is paying $30,000, and is sentenced to prison for 4 months. Salmon's shareholders, including myself, paid $290 million, and I was sentenced to 10 months in prison as CEO." What is the takeaway here? Stay within your area of expertise. Number 13, General Re. General Re is a reinsurance company that writes insurance for other insurance companies. This typically covers risks that would otherwise bankrupt individual insurance companies, such as natural disasters. However, she purchased this company in 1998, and paid $22 billion for it. This transaction was funded with Berkshire stock and diluted shareholders by issuing 22% more shares. When considering the P, Buffett used 22% of his net worth in this transaction. E. The deal's ratio, which was 23 based on 1997 earnings. One might wonder why Buffett did it. It didn't appear to be very Buffett-like, but that would be missing an important aspect of why Buffett made this purchase. It had a float of around $15 billion. It's time to quickly explain what float is and why it's been so important in Buffett's wealth accumulation. Simply put, float is the money that a bank or insurance company holds that isn't theirs but is theirs to invest every year. Insurance holders pay a premium to remain insured, but this money is not always returned immediately. Consider this. When was the last time you filed an insurance claim for yourself? It can take years for claims to be paid out. And, as with reinsurance, it is, of course, quite common. It may appear strange that claims plus operational costs are greater than premiums over the life of an insurance policy. Are insurance companies in the business of losing money? They are not. Insurance premiums can be used as capital and earn investment returns before claims are paid, which is where Buffett and his exceptional investment skills come in. So the success of an insurance company is determined by the cost of generating float, and the investment returns produced by the float. Berkshire and Buffett have excelled at both of these. However, the results of this investment have been mediocre. Buffett explains in his 2016 annual letter to Berkshire shareholders why it was a terrible mistake on my part to issue 272,200 shares of Berkshire in buying General Re, an act that increased our outstanding shares by a whopping 21.8%. Because of my error, Berkshire shareholders gave far more than they received, a practice that, despite biblical support, is far from blessed when purchasing businesses. In 1977, blue chip stamps were used to deliver the Buffalo Evening News, the Buffalo Evening News, or simply the News. This company was purchased by Blue Chip for $35.5 million. After including later indirect purchases in the company through Buffett's, ownership in Blue Chip increased. Based on its earnings in 1976, this investment represented 22% of his net worth. At AP, the company was purchased of a staggering 50. And I believe this requires further explanation. Buffett has stated that owning a market-dominant newspaper was the equivalent of owning an unregulated toll bridge back in the day. Pricing power was exceptional, both toward readers and advertisers. However, the News was not yet dominant in Buffalo. They competed with the Courier Express, another newspaper. In Buffalo, the News was strong, but not strong enough. I have no doubt that when Buffett entered this transaction, he was betting that the Courier Express would fail sooner or later. And it did, after a bloody battle, in 1982, The news went from a loss of $1.2 million in 1982 to a profit of $19.4 million in 1983. Remember, this was on a $35.5 million investment. Blue Chip ran into a slew of problems soon after purchasing the news. The Courier Express, the other paper in town, sued, and unions went on strike at the same time. Buffett can be tough at times, as evidenced by this incident in 1981, when union leaders went on strike on a Monday and Buffett told them, "If you come back in a day, I know we're competitive. If you come back in a year, I know we won't be competitive, and if you're smart enough to figure out where the line is where you can push us and still come back and we have a business and you have jobs, you're smarter than I am. So go home and figure it out for yourself." They returned on Thursday, November 11th. General Store. Back in the 1980s, General Foods was a major player in American supermarkets. It owned brands like Jell-O, Maxwell House, Coffee, Post Grape Nuts, Bird's Eye, Frozen Peace, Kool-Aid, Oscar Mayer, Hot Dogs, Log, Cabin Syrup, Ronzoni, Spaghetti, Cool Whip dessert topping, and so on. And the majority of these were once the number one in their respective categories in the country. During the period 1979 to 1983, Buffett acquired shares of General Foods for Berkshire for about $150 million, representing 25% of his total net worth at the time. Philip Morris acquired General Foods in 1985 in a massive merger worth $5.6 billion. Remember that when Capital Cities and ABC merged, it was the largest non-oil merger of all time. That lasted only 8 months. Although Tom Murphy was stripped of his title, I don't believe Buffett was upset. His Berkshire made $338 million from this transaction, which included a buyback in 1980, for a 240% return on the General Foods investment. Buffett explained why he made this purchase. In his 1985 letter to Berkshire shareholders, he mentioned 4 factors that helped us. A low purchase price, a business with strong underlying economics, and a buyer willing to pay full business value enable management to focus on the interests of shareholders. While the last factor is the only one that generates reported earnings, we believe that identifying the first 3 is critical to creating value for Berkshire shareholders when selecting common stocks. We focus on appealing purchases rather than the possibility of appealing sales. A key takeaway is that owning the number one brand, even in smaller niches like frozen vegetables or packaged desserts, can be extremely profitable. Okay, now that we've made it into the top 10, I'd like to ask you for a favor for the YouTube algorithm. Please pause the video now and choose which company you believe will be number one. Please do that right now. Awesome. Alright. Wesco Financial is ranked 10th. Wesco's primary source of income came from a savings and loan subsidiary known as Mutual Savings and Loan. Its primary sources of income were loan and investment interest over savings deposit interest plus some associated service charges. The majority of the business was centered on mortgages. When Buffett first bought it, it also functioned in part as an insurance agency. Buffett's blue chip stamps made larger purchases in 1972, 1973, 1974, and 1976, totaling 80% of the company for approximately $31 million. Finally, in 2011, Berkshire purchased the remaining 20% for $550 million. As you might expect based on the company's valuation, this investment proved to be a flop. In 2011, the $31 million invested in the company up until 1977 had returned a 7,000% profit. Direct and indirect purchases of the company via blue chip stamps accounted for 26% of Warren Buffett's net worth. Once again, Buffett had discovered a company with float or, at least, depositors, which meant capital to employ, but perhaps more importantly in this case, Buffett had discovered a manager that he admired. Louis Vincenti joined Wesco in 1955 and quickly climbed the corporate ladder to become its CEO, in Buffett's 1979 letter to Berkshire SH. He referred to Louis Vincent, then 74, as one of his rising stars who continued to achieve more each year. Number 9 on this list was not only significant at the time of purchase, it is now one of Buffett's top 3 most important holdings in terms of the outcome of its national indemnity insurance. This investment is worthy of a story in the world of Buffett himself. Our entry into the insurance business will be 40 years old next month. Berkshire purchased National Indemnity and its companion company, National Fire and Marine, from Jack Ringwald for $8.6 million on March 9, 1967. Jack was a longtime friend of mine and an excellent but somewhat eccentric businessman. Every year, for about 10 minutes, he felt compelled to sell his company. But those feelings, which may have been triggered by a disagreement with regulators or an unfavorable jury verdict, quickly faded. In the mid-1960s, I asked mutual friend and investment banker Charlie Hyder to notify me the next time Jack was in heat. When Charlie's call came, I spent to meet Jack. We came to an agreement in a matter of minutes, with me waiving an audit, doing Jillian's, or doing anything else that would give Jack a chance to reconsider. We simply shook hands and said our goodbyes. So the company was purchased by Berkshire Hathaway in 1967, and it represented the company's first significant diversification away from its core textile manufacturing business. Buffett's initial investment was $8.6 million, representing 9% of his net worth. However, as Buffett's stake in Berkshire Hathaway grew, his indirect purchases in the company increased that to a total of 27. In 1966, the company had an underwriting profit, which is unusual in the insurance industry, and the income after investments, etc., amounted to $1.6 million. When Buffett bought it, the P was 5.4. But keep in mind that insurance companies fluctuate a lot, and this deal was the real start of Buffett's insurance journey, and as a result, it had a huge impact on his future wealth, both directly and indirectly. Berkshire and its shareholders have profited handsomely from this investment. Underwriting profits were made by National Indemnity. Float and Jack Ringwald. The float in 1967 was approximately $17 million on a $8.6 million investment. Not too shabby. Remember that General Re had a float of $15 billion, but the price tag was a whopping $22 billion. There are numerous important lessons to be drawn from this single investment, but one obvious one is that an investor must be able to trust his own skills and intuition when an opportunity presents itself. It's possible it'll never return. In the case of National Indemnity, Buffett would have most likely had another 10 minutes the following year. Number 8 Horse, Child Cohen and Company, Hopeshield. Back in 1966, this was the deal that launched diversified retailing with Charlie Munger and David Gottsman. Hopeshield Cohen & Company was a department store on Howard and Lexington Street in Baltimore. Buffett, Munger and Gottsman put up about $6 million of their own capital and then borrowed another $6 million from two fellows at the prestigious Wall Street firms Goldman, Sachs, and Kidder. Peabody. Buffett didn't have the same clout in the investment world back then as you do now. And these two fellas only agreed to borrow and diversify the funds if they could do so under fictitious names. So the total cost of the transaction was about $12 million, or 28% of Buffett's net worth. And the department store earned somewhere in the neighborhood of $1.4 million, yielding an 8.5p. The outcomes. This is, in fact, Buffett's worst investment, as it appears so high on the list. The company was sold for approximately $11 million in 1969. Buffett believes that humility looks good on a billionaire, and he is not afraid to admit his mistakes. It should be noted that your chairman, who is always a quick study, only needed 20 years to recognize the importance of buying good businesses. In the meantime, I look for bargains and have had the misfortune of finding some. My punishment was a crash course in the economics of short-line farm implement manufacturers, third-place department stores, and New England textile mills. A key takeaway is that you must sometimes admit that your initial assumptions were incorrect, or that they proved to be so. Although I dislike preaching trading mantras, I believe in cutting your losses. Short-term investing applies at times too, or as Charlie Munger puts it, scramble out of your mistakes. Illinois National Bank and Trust is ranked 7th. This was a well-managed bank that Buffett purchased as Berkshire's second large investment. In 1969, he paid $18.9 million for approximately 100% of the shares when earnings before security losses were considered. In 1969, a P was worth $2 million. We are now approaching the really big deals that Buffett made, as this bank cost him 31% of his net worth after accounting for indirect purchases through his later increased ownership in Berkshire, and it proved to be a quiet profitable investment. Illinois National Bank and Trust had to be divested from Berkshire in 1980 due to the Bank Holding Company Act of 1969. Buffett decided to sell the bank to Berkshire shareholders by giving them the shares of the bank. Previous dividends and the sale price resulted in a 130% return. However, Berkshire shareholders' returns were likely higher because they received shares in Illinois National Bank and Trust at a low price in 1980. Buffett was disappointed to have to sell this bank, quote. However, you should be aware that we do not expect to be able to fully or even substantially replace the bank's earnings power from the proceeds of the sale. You can simply purchase high-quality businesses at the price-to-earnings multiples that are likely to prevail in our bank's sale. Here's a quote that summarizes many of the reasons Buffett bought the bank in 1969. Eugene Beck ran a bank in Rockford that earned 2% on assets when the best banks earn 1%, and he did it with far less leverage than anyone else, lower loan losses, and a large investment portfolio, and there was no magic involved. He just didn't do anything out of the ordinary. The takeaway here is that you should only invest in companies that have a proven track record. Both the managers and the operations should have a long track record. This investment advice also serves as good marriage advice. Purchase a proven track record rather than a fixer-upper. 6th place. Geico. In 1976, Geico was the 4th largest auto insurer in the United States, with a market share of about 4%. When Buffett first purchased Berkshire Hathaway stock for Berkshire Hathaway in 1976. In 1980, he acquired 33% of the outstanding shares for a total of $47 million. Share ownership was later increased to 50%. Geico made repurchases until 1996, when Berkshire Hathaway purchased the remaining half of the company for $2.3 billion. That's correct. He spent $47 million, $2.3 billion on the first half. Geico hasn't stopped performing since 1996, either. It is the second largest auto insurance company in the United States. In 2019, the company had a market share of about 14%. Buffett stated that Geico's underwriting profits have totaled $15.5 billion, $22.1 billion since its acquisition. I believe it is fair to say that the company was nearly 1,000 bag of a buffet on his 1976 to 1980 purchases, making it his best investment of all time. This was fortunate because Buffett spent 33% of his net worth on the company in 1976. This remarkable future development, on the other hand, was not so obvious. Perhaps it was to Warren Buffett Geico had been under-reserving for losses for many years, resulting in them pricing their policies too low in 1976. Claims piled up, and Geico was on the verge of bankruptcy. Benjamin Graham, Buffett's mentor, had been a director of the company for many years but had recently retired. In an interview, he stated, "It makes me shudder to think of how much money they were able to lose in 1 year. Incredible. To lose that much money, you'd have to be a genius." As a result, the stock had dropped 97% from its peak, but Buffett believed that the situation was only a temporary financial issue unrelated to the power of the brand or the underlying business. First and foremost, Buffett's Geico was extremely inexpensive. Second, it had a significant business advantage over other auto insurers that was difficult to replicate. It sold its insurance through direct marketing rather than through agents, effectively eliminating the middleman. This allowed it to have higher margins than other insurers as long as it priced its policies correctly. Third, it had recently installed new management Jack Byrne, who had previously proven himself at Travelers Insurance and was determined to right the ship. Aside from that, Buffett has admitted to owning 65% of his network in Geico shares in 1951. Buffett was not yet the guru that he is today. However, at that point, I will not include that investment on this list. In fact, I won't include any investments made before Buffett became a millionaire in 1962. Otherwise, the city service preferred that he bought for $114 back in 1941 when he was only 11 would probably top this list because he was pretty much all in at the time. J. Reynolds Manufacturing. I find it remarkable that so little has been written about this massive investment in Buffett's in the early 1980s. Reynolds was the largest tobacco company in the United States when Buffett bought it in 1980. However, it was quite diverse at the time, with other businesses accounting for 20% of revenues and 20% of profits in 1979. The company owned the fast food chain KFC, among other things. Reynolds was purchased by Berkshire Hathaway and Blue Chip Stamps, with Berkshire's share of the purchase totaling $270 million, including its ownership in Blue Chip Stamps. This accounted for approximately 34% of Buffett's net worth at the time. Reynolds was purchased for an absurdly low multiple of P/E4. Although it is unclear when exactly Buffett sold the shares in 1984. It is reasonable to assume that it occurred in conjunction with Reynolds' offer to repurchase 10 million of its shares at a price of $73.50 per share. If this is the case, the deal's returns would increase to 50%. Which is a little odd for a Buffett. As previously stated, Buffett has not been forthcoming about this investment, so I can only speculate as to why he was interested in acquiring the company. It was a dominant player in its industry, controlling roughly 1/3 of the US market. At the time, it had the highest return on capital of any tobacco company. And, by the way, the valuation was insanely low. I honestly don't know what was up with 1985 and mergers. Remember what I said about Capital Cities and ABC holding the title of largest non-oil murder for only 8 months? Well, it turns out I was mistaken. They only kept it for 3 months, as in June 1985. J. Reynolds announced a $4.9 billion acquisition of Nabisco Brands, a large food company. #4. The American Express brand. You may be aware of what American Express is today, but do you know what it was? When Buffett first bought it more than 50 years ago, it was primarily a seller of traveler's checks, which served the same purpose as a credit card and or an ATM does so today. When you go on vacation, you can use your prepaid American Express card to get cash in a local currency or to pay merchants. It had also recently released its credit card, but it did so as a defensive measure to protect its business from potential diners. Buffett bought 5% of the company for his partnership. Between 1964 and 1966, BPL was in charge. The cost was $13 million, which amounted to 43% of his net worth at the time. The investment had even surpassed the 40% limit that Buffett would allow the partnership to have in a single security. The majority of the holding was sold in 1967. And, while there is no official record of how well this worked out, it worked out pretty well. I estimate that the return was around 140% for a bet of this size, which is massive for such a short holding period. The main reason Buffett was interested in purchasing this stock at the time was that it was a strong business franchise with a temporary price drop. Buffett defines business strength as the ability to charge more for a product while maintaining or increasing market share against well-entrenched, well-known competitors. People remember you for something very special. The same thing happened when the credit card arrived. Furthermore, its stock price had recently dropped from $65 in November 1963 to $37 in January 1964. This was due to the company's infamous salad oil crisis, but Buffett recognized that the potential cost of this crisis was nowhere near enough to bring the company down. In addition, he conducted scuttlebutt research, as Philip Fisher had taught him. He realized that the company's main customers continued to use its products as if nothing had happened. Buffett bought American Express again between 1991 and 1995, and it remains one of Berkshire's largest holdings to this day. CS Candies are still ranked third. See's Candies was and still is a candy company that sells premium chocolate buffets. From 1972 to 1973, See's Candies purchased 99% of the company with blue chip stamps. The total cost was not $25 million, as many other sources claimed, but $34.7 million, according to the Blue Chip Stamps, 1973 10K report. However, the first 67% of the company cost Buffett $25 million. And there's an intriguing backstory to it. The controlling family wanted $30 million, as Charlie correctly stated, but I refused to pay more than $25 million gulp. My erroneous caution could have derailed a fantastic purchase. However, the sellers decided to accept our $25 million bid, and calculating the percentage of Buffett's net worth that was invested in this business involves a lot of assumptions due to the large number of indirect purchases through increased ownership of blue chip stamps. Buffett initially owned only a 19% stake in Blue Chip at the time of the first purchase in 1972, but this later increased to 46%. Because of its soaring revenues and profits, this was clearly increasing in value. However, I estimate that the first purchases accounted for approximately 18% of his net worth, with subsequent indirect purchases accounting for 26%, for a total of 44%, CES being purchased at a P/E. The score was 17.5, which was unusually high for a Buffett. It's a good thing he listened to Charlie Munger, because this business has provided Berkshire with approximately $2.3 billion in pre-tax profits over the years. The significance of this investment cannot be overstated. Buffett has stated that, just as Adam and Eve initiated an activity that resulted in the extinction of 6 billion humans, we have given birth to multiple new streams of revenue. Probably more importantly, he sees open buffets and eyes to quality businesses where he had previously only focused on bargains. It is preferable to own a fantastic company at a reasonable price than a fantastic company at a reasonable price. Finally, it's time to discuss an investment that has been mentioned throughout this video, number 2 blue chip stamps. As you may know, Buffett and Charlie Munger used blue chip as an investment vehicle to acquire other businesses. Can you guess which feature it possessed that made it especially useful for that? That is correct, float. The stamp trading business was a marketing giveaway. Customers who bought something in a retail store were given stamps to collect in small booklets with enough stamps. They were able to redeem items from blue-chip retailers who paid blue-chip for the stamps and then marked up their merchandise accordingly. However, it usually took some time before the stamps were redeemed, and some customers completely forgot about or lost their stamps. This meant that blue-chip had a lot of money that they could invest in the meantime. While waiting for customers to redeem in this manner, the company reminded Buffett of insurance in his own words. Indeed, in 1970, approximately 60 billion of our stamps were licked, pasted into books, and taken to blue-chip redemption stores. Our reward catalogue was 116 pages long and chock full of tempting items. I thought I had finally found a sure thing when I was told that even certain brothels and mortuaries gave stamps to their customers. There is a second part to that quote, which will be revealed in a moment. Buffett purchased blue-chip stock for himself, BPL, Diversified Retailing, and Berkshire Hathaway. As a result, calculating the total purchase price is a bit difficult. Furthermore, blue chips began purchasing other valuable businesses on this list, such as See's Candies, Wesco Financial, the Buffalo Evening News, and so on, but I estimate that the purchase is attributable to blue chips. From 1968 to 1974, the cost of core business stamps and float was approximately $26 million. According to my estimates, the total value of blue chip holdings then exceeded the total market capitalization of the company. As a result, I'll leave those purchases out of this list. Nonetheless, Buffett invested 44% of his net worth in this holding, and the outcome. Now for the second part of that quote. It hasn't been quiet since Charlie and I stepped into the blue chip picture. The company's fortunes plummeted. By 1980, sales had fallen to $19.4 million, by 1990, sales had stabilized at $1.5 million. No quitting. I increased my managerial efforts. Sales dropped another 98% last year in Berkshire's $98 billion, $25,920. Blue chip ever hopeful Charlie and I soldier on with no zeros omitted. It would be completely inaccurate to say that this purchase was not profitable. Buffett was able to multiply his capital by using blue chip. He could allocate to other businesses, such as the previously mentioned 3 C's, the News and Wesco. Without these, neither Berkshire nor Buffett would be where they are today. Finally, the most important investment that Buffett has ever made is, give me a drum roll, please, Berkshire Hathaway. Berkshire Hathaway was a textile manufacturer in the early 1960s, operating in a difficult industry, but it had valuable assets. Buffett began purchasing the company through BPL in 1962 and originally intended to sell his holding back to those running the company in his 2014 annual letter. Buffett explained the situation to Berkshire shareholders as follows. Berkshire Hathaway, then led by Seabury Stanton, sent a letter to its shareholders on May 6 offering to buy 225,000 shares of its stock for $11.375 per share. I expected the letter, but the price surprised me. Buffett had anticipated a bid of $11.50 per share. Because this was the deal he and Seabury had agreed on beforehand, rather than accepting the new bid and selling his stake in the company for 1% less than originally agreed. Buffett became enraged and decided to take control of the company instead, so he continued to buy shares. By April 1965, BPL had 392,633 shares out of 1,017,547 then outstanding, which he later described as a mistake. And, at a board meeting in early May, we formally took control of the company thanks to Seabury's and my childish behavior. After all, what was an eighth of a point to either of us? He lost his job, and I found myself with more than a quarter of BPS capital invested in a bad business about which I knew nothing. BPL eventually owned 70% of the company. In true Buffett and Munger fashion, they scrambled to correct their errors. However, Fashion Buffett devised a strategy in which Berkshire could generate high returns on capital as long as the company redirected its cash flows into new great businesses and away from the failing textile one. This triggered a series of purchases, beginning with National Indemnity. Buffett purchased Berkshire shares for himself in 1967 for BPL and diversified retailing from 1962 to 1973. Actually, the purchase was made up until 1977, but, like blue chip stamps, the individual Berkshire holdings became more valuable than the total price of the business. At one point, the price of the shares attributable to the core business was $18 million, which represented 52% of Buffett's net worth at the time. Berkshire's earnings in the early 1960s were extremely volatile, ranging from -$2.1 million to $4.6 million. As a result, P/E isn't really applicable here. However, when Buffett took over in 1965, the company was almost selling below its net current assets, which Buffett's mentor, Benjamin Graham, admired. Also similar to blue chip stamps. Berkshire's core business eventually failed in 1985, and Buffett decided to close the last textile operations, but back in 1965, a single Berkshire share was trading at $15, today, it costs more than $300,000. Despite the fact that you would have been diluted several times. This is approximately a 10,000 bagger if you have owned the stock since 1965. I'm not sure if there are any other stocks that could be compared. If you know of any, please let me know in the comments. That concludes the top 25 most important investments made by the legendary Warren Buffett.